year of the Honors Social Work program on the Aurelia campus. The Canadian Foundation for Economic Education is pleased to partner with the National Bank of Canada to provide a series of workshops to help post-secondary school students like yourselves across the country get a better handle on their money. Today's topic is buying your first home, and we will give you an overview on all the pieces that go into buying your first home. This workshop will last about an hour, and then we will have a live Q&A, like Michelle mentioned, for about 30 minutes at the end of the presentation. These workshops are intended to serve as a foundational resource to get you thinking about your finances, not as a final stop in your financial journey. Consider the information and see how you can apply the concept we've covered to your personal financial journey. Also, please understand that while we do our best to answer all related questions, we will not be discussing topics beyond the scope of today's conversation. If you have specific questions that we're unable to address, please consider setting up an appointment with a financial professional. As Michelle mentioned, we sent a pre-survey in the chat. We hope you completed it, and there will be a post-survey sent in the chat at the end of the session. If you fill out both, you will be entered into the draw for one of 4 $50 Tim Horton gift cards chosen among eligible students this semester. And don't worry, they won't be using your email for any other reason except for this draw. So the CFEE and the National Bank have partnered to offer post-secondary students across the country access important financial literacy workshops. The program, Help Managing Your Money on Campus, is designed to help support students by providing comprehensive financial education modules. This is so important and timely because more than ever, we live in a complex financial world. The majority of you have likely already experienced this world of financial costs, responsibilities, planning, spending, debt, credit cards, and much more. And that's exactly why we're partnered with universities and colleges across the country to help equip students with the information they need to take on all of life's financial challenges. In the first half of 2020, CFEE asked students about their priorities and what they want to learn more about. Nearly 1,500 students answered the survey from 94 different post-secondary institutions. This is what they found out. So the research identified that nearly 2/3 of students are currently dealing with financial stress, plus 55% of students are looking for help building a financially healthy life. Also, over half of students wanted to learn how to manage a major expenditure. We hear your concerns and we understand your challenges. That's why we put together today's presentation. Buying your first home is likely going to be the largest expenditure in your life, so hopefully this workshop can help you understand what is involved in buying a house where you can get some help to alleviate some financial stress. So I'll get to, sorry, Chad, can you just put the pre-survey link in the chat one more time?
For sure.
Thank you.
Oh.
All right, so today we're going to talk about 3 major topics. So first, we'll discuss the costs and pros and cons of renting a home versus buying a home. So there are many trade-offs to consider when considering the purchase of a home. So we'll try to make sure you have thought through and are aware of all of these things before proceeding. Secondly, there's a lot of steps to buying a house. One of the key ones is to be aware before starting to look at houses is how much you can realistically afford. There are lots of components to this aspect, so we will cover those in sufficient detail so that you shouldn't have sticker shock when purchasing. Lastly, there are a lot of government programs available for first-time buyers and professionals available to help you make what will likely be the biggest purchase of your life. So coming out of this workshop, you'll have a much better understanding of how much you can spend on a house. You'll understand the multitude of government programs to assist you and other service providers who can help you in this major purchase. So first, we're talking about renting versus buying. There are a lot of trade-offs to buying or renting a home. This includes like cost, mobility, repairs, etc. Roughly 2/3 of Canadians own their own home, but it's not something that everyone will do. Given the increase in house prices, it may be better for some Canadians to own or rent. So we're going to cover the cost and the pros and cons of renting versus buying. So we're going to launch a quick Zoom poll. So the question is, do you intend to buy a house? And there's no right or wrong answer. Just feel free to pick any of the options below. Okay, I'm still waiting for just one more person. Perfect. Okay, so based on the results, I can see here that majority are hoping to buy a house within the next 5 years, especially if you're in your first year, that makes sense. One person is hoping to buy within the next year, and 2 people are hoping to buy within the next 3 years. So thank you for participating, and it's great that everyone here is interested in actually buying a home. So the ongoing costs of renting. So while you might not pay all of the costs directly, do be aware that the owner or the landlord you are renting from is renting to you to earn a profit on their investment, the home. This will not be directly observable in any of the costs that you pay. So often items like property tax and property insurance are included in your monthly rent, but you just pay one amount each month. Rest assured, though, that you are paying those costs in the monthly rent if your landlord has priced the rental of the property properly. Also, you will likely pay for renters or tenant insurance, and this will be more so for the contents like your stuff rather than the building itself, and it will be much cheaper than the property insurance, which would cover replacing the building if it's, say, burned down. You may or may not be responsible for some repair costs. Like you wouldn't likely be responsible to pay for major expenses like the roof or a water heater. But chances are, maybe small things included in your rent you would be required to pay. Potentially you damaged it. So chances are you're paying for heat, water, sewer, electricity. Potentially you have an all-inclusive rent, so all of your utilities are covered. And then of course you're probably paying internet, cable, and phone. If you have an all-inclusive deal with that in your rent, then you're pretty lucky. It's not very common. All right, so when you own, as you can see on the chart here, you're responsible for all of the costs directly. So a mortgage, for example, is a loan that you take from a financial institution where the financial institution gives you the money to buy your house above your down payment. So this is a form of a secured loan, as the lender can take your house if you don't make your payments. A secured loan will thus tend to have a lower rate when you pay your mortgage. Your monthly payment will include the principal, so repaying the original loan, and some of the interest. In the early years, most of your monthly payment does go to the interest. Your mortgage payment will have a component for paying back the loan or the principal payment and interest on the loan. While you don't pay interest directly while renting, the landlord has likely priced in a return on investment into the monthly rent, which would likely be more than the interest you pay on your mortgage. Also, to get that mortgage, you need to make a large dollar down payment. We will cover down payments later, but that can be one of the biggest challenges for people buying their first home. When you own a home, for example, if the furnace just dies in the middle of the night in mid-January, you are responsible for contacting the repair person, paying them, and then of course paying the cost of and the time that it takes to replace the furnace if it has to be replaced. So these are some things to consider, and of course, heat, water, sewer, electricity, internet, cable, phone, all those things you're responsible for. And as we discussed earlier, property insurance, property tax, those are things you'll also be paying directly. So the pros and cons of buying a house. So we've already discussed the cost, but perhaps let's point out that you need an emergency fund. So that is 3 or more months of living expenses saved if you haven't attended some of our other webinars. If you own a house, for major unexpected costs, like again, the water heater, potentially the furnace or the roof, etc. Because again, you are responsible for all the costs and they can be very expensive repairs. So the second kind of pro and con is that the pro is that you do build up equity. So this means that as you pay the monthly mortgage, which is mainly interest when you first get the mortgage, but eventually some of the principal cost, you're paying down the original loan amount. And hence, when you do sell, you will have built up equity. However, if house prices go up and this is your principal residence, the gains are tax-free when you sell your house. So this could be a pro. So the house can be a very good investment if the prices don't go down, and that can help you build up equity as well. Paying a mortgage and the other costs of owning a home will more than likely cost more than renting. So due to this, and given we all have a set monthly income, you will likely have less money to invest elsewhere. So this is the con of potentially owning a home. And then, of course, another pro is that you have pride in ownership. You can say, I own a home, which is something that, Canadians tend to do, take pride in. And then you have stability and peace of mind because, your landlord can't evict you, like you own the home. And then you have the freedom to take down walls, paint, do all those fun renovations. But some of the cons are that you'll have less flexibility in where you live. So if you're not quite sure where you want to end up in your job, this could potentially be a downside for you. And of course, it could lose value, like we talked about. And you're again at the risk of increases in interest rates. All right, so some key takeaways from this section is that costs are different between renting and owning. Much more important, it's important to have a larger emergency fund if you do buy a house, due to the potential larger cost of needing a new furnace, a roof, a water heater, etc. So the second key takeaway is that there are many pros of owning a house, but there are also several cons of owning a house. So net loss. Lots of good things about buying a house, but let's move on to what's involved in buying a house. Okay, so as you're getting ready to buy a house, so as we mentioned earlier, one of the key aspects to getting a good handle on before you start looking at online listings or going to open houses is how much house you can truly afford. Lots of pieces to get to that magic number. One thing to be aware of is that the tendency, once you have your number, is to stretch a little bit. Be careful because even with all the best planning, there will likely be unexpected costs. Do your best not to stretch so much that you can't truly afford the house you buy, as it is very expensive to sell a house. And as best as possible, you want to ensure that you can live in the house you buy for several years. All right, so we're going to launch another poll to test your knowledge. So how much of a down payment do you need to buy a house under $500,000 as a percentage of the purchase price? All right, here we go. So is it 0%, 5%, 10%, 20%, 32%, or 50%? All right, we're just waiting on one more person. Perfect. Thank you everyone for participating. So the correct answer is 5%. So 4 of you got that right. Congratulations. Thank you. All right, so it will be very important to know how much of a down payment you can afford. The minimum amount is 5% of the purchase price in Canada. If you don't pay at least 20% of the purchase with your own money, you must buy mortgage default insurance. It is wise to get pre-approved for your mortgage to have a better idea of what you can afford. Your real estate agent may require this before you can even begin to search. We'll have more details on this in a few slides. There are a lot of lingo when you are getting a mortgage, and we will help you understand that better. So the down payment. So again, the down payment can be as low as 5% if your house costs less than $500,000. The amount of a down payment goes up as the house cost exceeds $500,000. So you can build up your down payment through regular savings, gifts from your family or friends. A tax-free savings account or a TFSA can be a great source of down payment for a house. A TFSA allows you to save money into an account with no tax consequences or other penalties when you withdraw money, as long as you are not removing a contribution you deposited in the same calendar year. The current limit on TFSA contributions is $6,500 per year. So there are many government programs available to help you with down payment, and we will go over that more in section 3. Saving for a down payment is a great example of a budgeting and goal setting exercise. Make sure to make a plan to save for your down payment and ensure to be realistic and specific in how you will achieve your goal. So remember SMART goals: specific, measurable, actionable, realistic, and with a time frame. It will take several years to save for your down payment, and be sure to celebrate successful milestones along the way in your goal to saving for your down payment. Also, as you are proceeding down your journey to save for a down payment, make sure to be eliminating other high cost debts and also practicing good money habits. So again, making sure that you've built up an emergency fund. So this is 3 to 6 months of expenses before buying a house as well. This will serve you very well when you do purchase your first house. If you have less than a 20% down payment, mortgage default insurance is a must, and it must be purchased, which we will go into detail in a few more slides. So, stable income. Most mortgage providers will want to see at least 2 years of stable income. The mortgage provider will ask you for things like a pay stub, a tax return, and other evidence of your employment income. If your income is part-time, this might make it more challenging for you to get a mortgage, as you won't have made as much money likely as someone working full-time. Also, if you have a variable income, such as being paid on commission or through self-employment, a mortgage provider may scrutinize your mortgage application more closely. If you have had a few months or quarters of low or no income, that can hurt your chances of getting a mortgage. So in Canada, you do need a credit score of about 700 or higher to qualify for a mortgage at most financial institutions. A credit score is a numerical summary of the information contained in your credit report. You can get this through Equifax or TransUnion annually for free. If you have credit cards, loans, a cell phone bill, etc., then you likely have a credit report. So meeting your future goals does depend on your credit score. The 2 most important things that go into your credit score are your payment history. So do you pay all of your bills on time, your cell phone, your Netflix, your hydro, your water, etc. And 2, your credit utilization, the amount of debt outstanding to total credit available. So as a rule of thumb, try not to have more than 30% of credit limit outstanding at any one time. So if you have a $1,000 limit on your credit card, then try not to have more than $300 outstanding at any one time. For the 10% piece of the pie for new credit/inquiries. So you need to differentiate between hard and soft checks. There are some resources in the document provided to you through the email. So a hard check is when you authorize a lender to check your credit. So this is for like a mortgage. Several of these within like a month or so will count as just one inquiry. So potentially a credit card application, renting a property, a new cell phone, and they will stay on your credit report for 2 to 3 years. A soft check is when you get your free annual report, a company inquires to see if you qualify for credit, an employer does a background check on you. Correcting past issues will take time. People looking to extend you credit will want to see 12 to 24 months of good behaviors. Paying on time for 1 month won't help you. It needs to be consistent, a habit. You can likely access your credit score on your banking app for free. Okay, so getting a mortgage. A mortgage is probably the largest borrowing you will ever have to do um, during your life. While the banks want to lend you the money, that's how banks make money, they also want to be as protected as possible. At the end of the day, if you don't make your mortgage payment, the bank has the ability to seize your house, but that's not what the bank or you wants. The bank wants to make money on the interest rate they charge you versus the interest rate they pay customers on their bank accounts or GICs. So we will just pop over to this spreadsheet here for 1 second that Chad has made for us. So this spreadsheet talks about the mortgage fundamentals. So this is a mortgage calculator. You can find some of these mortgage calculators online that you can type in your own information, but for the purpose of this webinar, Chad just left it at 50,000 for the total house cost, the down payment of $75,000. So in that case, it's not 20%. So default insurance is required. And then the interest rate for the mortgage is 7% over 25 years. The minimum down payment was 25,000. But because of the 75,000, you owe $425,000 on your mortgage. And so your payment per year is $36,469 per year. And so this kind of breaks it down in terms of how much you've paid, how much principal remains, and then within that payment of $36,469, how much of it was paid in interest and how much of it was paid at the principal. So you can see here that, like we said before, the interest is much higher at the beginning versus at the end, and is much lower for the principal at the beginning and much higher for the principal at the end. So when you're getting a mortgage, there are limits to how much the Canadian mortgage home insurance and the lenders will lend you based on how much you are spending on your house, your income, and your other debts. The government of Canada brought in a stress test to ensure that you can afford your mortgage. This is actually a good thing, as you don't want to get in over your head. We described this stress test in more detail later in the module. There are a lot of other costs to be aware of before you show up on closing day to buy your home. So mortgage default insurance. So your mortgage provider will provide you to buy mortgage insurance if, again, you haven't put at least 20% down on the house you are buying. This is to protect the lender if you walk away from the property, as the lender then won't expect to lose any money when they are forced to sell your house as quickly as possible. So providers of mortgage insurance include the Canadian Mortgage and Housing Corporation, Genworth Mortgage Insurance, now called Sagan, and Canada Guarantee. So recall from the prior slide that your mortgage provider will require you to buy mortgage default insurance if you haven't put at least 20% down on the house that you're buying. This is again to protect the loaner if you walk away from the property, as the lender then won't lose any money when they're forced to sell your house as quickly as possible. So if you are buying a $300,000 house and you put 8% down, so $24,000, you will be required to pay an additional $12,000 or 4% just in mortgage insurance alone. If you can get to 20% or higher of a down payment on a house, it can save you the cost of mortgage default insurance. This should be something to strive for. Save money longer, find other ways to increase your down payment, like gifts from your parents, borrow from your RRSP, etc. So getting a pre-approved for your mortgage is very important to know how much you can afford. It's a good idea to get pre-approved for a mortgage before you start looking for a home, but you first need to understand exactly what pre-approved means. When your potential mortgage provider does a pre-approval process for you, this is an example of a soft credit check, which doesn't count against your credit score. When you go to get an actual mortgage, this is a hard credit check and it will impact your credit score. A pre-approved mortgage lets you know how much you can afford, what your interest rate will be, and what your monthly mortgage payments will look like. Getting pre-approved can help you narrow down your search to a specific home type, size, or neighborhood. Getting pre-approved is not a guarantee of final approval for a mortgage. Once you find a home you want to buy, the property still has to be evaluated to ensure that the price and the condition of the home are acceptable to your lender. Your real estate agent may require you to be pre-approved before beginning to show you houses. Also, it shows you are serious as a potential buyer to sellers. So, mortgage terms and lingo. So, a fixed rate is the rate of an interest that doesn't change during the term of the mortgage. The variable rate is the interest rate that fluctuates with market interest rates. So typically the prime rate, however, they may offer a cap on the variable rate. An open mortgage lets you pay off your mortgage in full or in part at any time without any penalties. A closed mortgage offers limited or no options to pay off your mortgage early in full or in part, but it usually has a lower interest rate than an open mortgage. So check with your mortgage provider, as you may be allowed to pay you might be able to pay extra scheduled payments and or 10 to 15% of the original balance per year for free. Mortgage prepayment charges are quite high otherwise. So high ratio mortgage. So a loan that is over 80% of the lending value of a home. So this means that the down payment is less than 20% and will likely require mortgage loan insurance. A conventional mortgage is a loan that is equal to or less than 80% of the lending value of your home. This requires a down payment of at least 20%. A mortgage term, so that is the length of time that the options and interest rate you choose are in effect. So this can be anywhere from 6 months to 10 years. When the term is up, you can renegotiate your mortgage and choose the same or different options. Amortization period, the length of time you agree to pay off your mortgage. So typically it's about 25 years. Payment schedule. So this is how often you will make your mortgage payments. So it can be weekly, every 2 weeks, bi-weekly, once a month, or accelerated weekly or bi-weekly payments. Prepayment options. So this is again the ability to make extra payments, increase your payments, or pay off your mortgage early without incurring a penalty. Portability. So this is an option that lets you transfer or switch your mortgage to another home with little or no penalty when you sell your existing home. Mortgage loan insurance can also be transferred to the new home. So this is the historical 5-year mortgage rate. So these can vary a lot, as you can see on this graph here. So be careful of getting a variable mortgage rate, as rates really don't have anywhere to go up. They don't have anywhere to go but up over time. Having a certain payment on your mortgage for the first 5 years can be really valuable too, as you will likely earn more money over time with raises, and so that monthly payment can be more manageable as you make more money. You can find a chart like this on Rate Hub, and you can actually choose the time frame yourself. So mortgage limits. So the CMHC and other lenders want to make sure that you don't overextend yourself. There are 2 tests to make sure that you have sufficient income to pay for your mortgage. So this is the gross debt service ratio and the total debt service ratio. So we are going to pop over to the spreadsheet again, and we're going to look at those. So the gross debt service ratio, it talks about your monthly housing costs. So your mortgage, principal, and interest, your taxes. So these should not exceed 32% of your gross household monthly income. And this limit is increased to 39% if you had mortgage insurance. So you can see here, this is potentially the monthly mortgage cost of $1,500, with $125 being the property taxes. And then let's say your heating cost is $75. So your monthly payment would be $1,700, and your annual would be $20,400. If your annual income was $40,000, you would not be able to afford this house according to mortgage loaners, because it is a gross debt service ratio of 51%, which does not fit into 32 or 39. The total debt service ratio, so similar, these should not exceed 40% of your gross household monthly income. And of course, this limit is increased a little bit for insured mortgage to 44%. So this talks about any loan payments. So this could be potentially student debt. Maybe you own a car, or maybe you have debt on your credit card. So that would be $200. And again, a similar situation of $1,500 for your mortgage, property tax, heating. So your monthly cost would be $1,900. Your total annual cost would be $22,800. And if your annual income is $40,000, then again, you would not be eligible to get a mortgage for this home, because it is 57% and it doesn't fall within either of these two. So these tests are to make sure that you have sufficient income to pay for your mortgage and the other costs like we just went over of owning a home. So the first affordability rule set out by the Canada Mortgage and Housing Corporation, or CMHC, is that your monthly housing costs, mortgage and principal interest, taxing and heating expenses, or PITH, should not exceed 32% of your gross household monthly income. And as we mentioned before, 39% if you have mortgage default insurance. For condominium, these expenses include half of your monthly condominium fees as well. The sum of these housing costs as a percentage of your gross monthly income is your GDS ratio. So again, the principal, the taxes, the interest, and the cost of heat divided by your gross income would give you your percentage. So if that situation that we showed before, you would want to have to lower your annual cost to $15,400, essentially getting a lower monthly mortgage, so that you could meet that standard of 32 or 39%. So mortgage limits. So the CMHC's second affordability rule is that your total monthly debt load, including housing costs, should not be more than 40% of your gross monthly income. Again, the limit is 44%, or I believe it was 49% if you, 40% or 44% if you are insured. So this, in addition to housing costs, again, this takes into account all of your other debts that you may have that we talked about. Yeah. So mortgage stress tests. So stress tests were actually introduced in only 2018. And this is a good thing because it ensures that you can actually pay your mortgage. And so these tests make sure that if interest rates increase, which they have in the past little while, you can still afford to pay your mortgage. So other closing costs to consider. So the land transfer tax, which you can find more information on the Government of Ontario website, is approximately 1% on the first $250,000 of your housing costs. Toronto then charges similar amounts on top of the Ontario charge. So just to be aware, if you're looking for a house in Toronto, there are prepaid property taxes and utility bills. A housing inspection could cost anywhere from $350 to $600. A property appraisal is possibly another $300 to $500. The legal fees associated with buying a house are probably anywhere from $500 to $1,000. If you need a land survey, they're about $1,000 to $2,000. A new home warranty is about $200. Title insurance is about $300. And then, of course, there's moving costs if you need to rent a truck or something like that to move all of your stuff or hire someone to do it. And then potentially repairs or renovations, depending on the house that you're buying. And you may be paying HST if you buy a new house, which may be rebated. Yeah. So the key takeaways from this section is that you need to know how much you can afford. You should get pre-approved for your mortgage, and you need to make sure that you understand all of the mortgage lingo. Before buying a house, you should prepare a monthly budget to ensure that you can afford all of the costs, including those that are only paid annually, like property tax, home insurance, etc., as it is very expensive to sell a house if you cannot afford it. All right, so on to our last section, which is government programs and assistance for you. So there are several government programs, federal and provincial, available to help you buy a house. You will likely want to get the assistance from a real estate agent when buying your first house, and a mortgage broker might be able to get you a better rate or a mortgage that is better suited for your needs. So we are going to cover government assistant, real estate agents, and primary bank and or mortgage brokers. All right, so the federal government assistance. There are currently 6 federal government assistance programs. Items 1 through 3 can directly help provide some of your down payment, and the others help offset the cost of buying or moving. So the home buyers plan, this is a great way to help you get a down payment. So recall that if you don't put down the 20% as a down payment, you need to pay the default insurance described earlier. The HBP is a program that allows you to withdraw from your registered retirement savings plan, or RRSP, to buy or build a qualifying home for yourself or a related person with a disability. You can borrow up to $35,000 from your RRSP with no tax consequences. However, you have to pay it back equally within 15 years. If you don't pay it back within 15 years, any unpaid amounts are added back into your current year income and you will pay tax on that amount. If you have money in a TFSA, you can remove from the TFSA at any time with no tax penalty. The tax-free home savings account. So again, this is a great way to get a down payment. So the FHSA will have an annual $8,000 maximum contribution limit, and unused contribution room cannot be carried forward. You get a tax deduction on the amount contributed, just like an RRSP. You can transfer funds specifically from an RRSP to an FHSA, subject to the $8,000 annual amount and $40,000 lifetime limits. Again, if you don't buy a home within 15 years, you've got to close the account, and then you can actually transfer what's left into an RRSP or a registered retirement income fund, or pay taxes on it if you choose. While the FHSA is a new initiative, it's received royal assent, so it will actually be taking place in April of 2023, so very soon. The home buyer's tax credit. So this is a tax credit if you must have sufficient taxable income to be able to get the full $1,500 back from the federal government. So for houses purchased after December 31st, 2021, the credit before December 31st, 2021, the tax credit was half the current amount. you can claim $10,000 as a credit against your income for the purchase of a qualifying home in the year if both of the following apply. And the current credit rate is 15% for federal taxes. So you and your spouse or common law partner acquired a qualifying home. You did not live in another home owned by you or your spouse or common law partner in the first year of acquisition or in any of the 4 preceding years. So you must be a first-time home buyer. So you will include $10,000 as a credit in tax filing, and if your taxable income is greater than the basic personal amount, plus the $10,000, then you would get the full $1,500 refund. The first-time homebuyer incentive. The program offers 5 or 10% of the home's purchase price to put toward a down payment. This addition to your down payment lowers your mortgage carrying costs and makes home ownership more available. The government now, in essence, owns a portion of your home and shares in the upsides and downsides of price changes. So as of June 1st, 2022, the plan has been updated so that the government of Canada will limit its share in the appreciation or depreciation of a home. So now homeowners will pay back up to a maximum gain or loss of 8% per annum, not compounded on the incentive amount from the date of advance to the time of repayment. So you can get a 5% incentive for all but new construction. For new construction, you may receive a 5 or 10% of the purchase price. This is your choice. So there are a few criteria to determine eligibility for the first-time homebuyer incentive. So your total annual qualifying income should not exceed $120,000. Your total borrowing is no more than 4 times your qualifying income. You or your partner are a first-time homebuyer. You are a Canadian citizen, permanent resident, or non-permanent resident authorized to work in Canada. You meet the minimum down payment requirements with traditional funds, so saving withdrawals, collapse of a RRSP, or a non-repayable financial gift from a relative or immediate family member. So the incentive is essentially a second mortgage on your home. Your first mortgage must be greater than 80% of the value of the property and is subject to a mortgage loan insurance premium. It must also be eligible through one of the 3 mortgage loaners that we talked about earlier. So this loan is repayable after 25 years or when you sell the property, or at any time you choose to repay, and the government shares in the upsides and downsides of the market value changes. So now we're going to watch a video of how the first-time homebuyer incentive actually works. Oh, sorry, 1 second.
Curious how the first-time homebuyer incentive works? Let's break it down. Your total borrowing, meaning the mortgage and incentive amount combined, is limited to 4 times your qualifying income. Your mortgage must be eligible for mortgage loan insurance. While a mortgage loan insurance premium is applied, it's excluded from the total borrowing calculation. Your down payment contribution must be a minimum of 5%. Meanwhile, your down payment has to be less than 20% when combined with the incentive amount. The government of Canada is participating in the transaction with you, which is why the incentive is registered as a second mortgage on the property. There are, however, no regular principal payments, it bears no interest, and it has a maximum term of 25 years. Here's an example. Let's assume you're purchasing a $200,000 home and you receive a 5% incentive equivalent to $10,000. If your home value increases to $300,000 by the time of repayment, your payback amount would be 5% of the current value, or $15,000. On the other hand, if your home's value decreases to $150,000, your repayment amount would decrease to $7,500. You'll need to repay the incentive after 25 years or when you sell the property, whichever comes first. You can also repay the incentive in full at any time without penalty. If you refinance the first mortgage, it won't trigger a repayment. For additional details, visit placetocallhome.ca. To learn how to apply, check out the last video in this 4-part series.
All right, so the next program is the GST/HST New Home Purchase or Major Renovation Rebate. So an individual home buyer and not a corporation or business partnership is eligible for this rebate if your home is listed as your primary place of residence and you've purchased a new or substantially renovated more than 90%, a single, semi, condo, townhouse, mobile, or modular home from a builder, or you purchased a share of interest in a cooperative home. The GST rebate is for up to 36% of the GST paid up to $6,300. Said another way, the rebate is approximately 1.8% of the purchase price up to 3,050. Oh my gosh, sorry. $350,000. Ontario rebate. The Ontario rebate is for up to 75% of the provincial portion of the HST, paid up to $24,000. Said another way, the rebate is 6% of the purchase price up to $400,000. So moving expenses tax deduction. So this is a tax deduction, so it will reduce your federal taxes at the marginal federal tax rate. This deduction is available for first-time homebuyers as well as anytime you move and meet the government criteria. Generally, you can claim moving expenses you paid in the year if both of the following applied. So you move to work or run a business, or move to study courses as a full-time student enrolled in a post-secondary program at a university, a college, or another educational institution. And you must have moved at least 40 kilometers closer to your new work or school. You can claim transportation and storage costs, such as packing, hauling, movers, in transit storage, and insurance for household items, including boats and trailers. And you can claim travel expenses, including vehicle expenses, meals, accommodations, if you have to stay in a hotel, to move you and your household members to your new home. So provincial government assistance. So there may be other programs available in your province. Your real estate agent, lawyer, and or mortgage provider or broker should be able to provide you with additional details. So this could include a land transfer tax rebate and other provincial programs. So the land transfer tax rebate is one of the largest upfront additional, a land transfer tax is one of the largest upfront additional costs of buying a home. Only for first-time home buyers, they may offset the land transfer tax cost, so approximately 1% or more for median priced homes. For Ontario, your lawyer should be able to ensure this rebate is automatically applied. You won't be out of pocket for the cost at all. The rebate for Toronto is in addition to the Ontario rebate, so just keep that in mind if you're living in Toronto. Oops. So other assistance in buying your home, so a real estate agent and a primary bank and or mortgage broker. So your real estate agent. So you don't actually pay for the cost of a real estate agent as a buyer. So this is a good idea when you're buying your first home. When purchasing a home, even your first home, you should consider to hire a real estate agent. Why? Because they're knowledgeable, they can ensure that you follow all of the steps, and the realtor can help you find reputable professionals if you're moving to another city, for example. A realtor can get you the information needed to make an informed decision. So comparable prices, neighborhood trends, housing market conditions, and much more. They also have access to the MLS system, which is the multiple listing services that is used to find cooperative brokers to work with buyers. It also lists existing offers and previous sales. Real estate agents will know about the local market conditions to insert in contract, and ensure that all of the correct steps are taken to help you buy your first home. The a primary bank. So your bank may also be able to help you when you're purchasing your first home. So banks like to have more relationships slash products with a client, and so they may offer you a preferred rate. So your bank may already have information like your current employer, recent tax returns, etc. That might help make the process easier. And this is the best way to set up automatic payments to your mortgage, and that it might be easier if it's your primary bank where you currently where currently your paycheck is already deposited. A mortgage broker is also a good source of information for getting a mortgage. So mortgage brokers are available for you at your financial institution, but some brokers also operate separately from banks and on their own. Getting an independent broker might provide you with more mortgage options, rates, and terms. Given you don't pay for a mortgage broker, it can be a good idea to contact one, even just to compare the rates and terms of your bank, what they provide you for your mortgage, and then it can be competitive tension can always help in negotiations. So here are some of the key takeaways from this section. So there are a lot of government programs to help you buy a house. A real estate agent can be very helpful in your first purchase, and of course you don't pay them directly. And your primary bank and or your mortgage broker can be very helpful in getting you a better rate and or the appropriate mortgage for you. In summary, we covered 3 very important sections and subsections in each one. The first section we talked about are the differences specifically related to costs when you're renting versus buying a home. The second section, we discussed the 7-step process to purchase a home. We also discussed some key ratios and calculations you should use when determining your mortgage eligibility. And the third and final section, we discussed 3 attainable assistance programs, which are made easily available to you, which can make your purchasing a home much easier. So just in summary, for renting versus buying, costs are different between renting versus owning. It's much more important to have a larger emergency fund if you buy. There are many pros to owning a house. There are also several cons to buying a house. In the second section, we talked about knowing how much you can afford. Getting pre-approved for your mortgage is very important, and making sure that you understand the mortgage lingo. Before you should buy a house, you ensure that you prepare a monthly budget to ensure that you can afford all of the costs. So this includes the annual costs that you don't think about often, like property tax and home insurance, as it is very expensive to sell a house if you can't afford it. And finally, we talked about lots of government assistance programs to help you buy your first house. The real estate agent can help you a lot. And again, your primary bank or brokerage mortgage can help you find a better rate or get an appropriate mortgage for you. So now coming out of this workshop, you should feel more comfortable that you understand that you have a much better understanding of how much you can spend on your house, the multitude of government programs to assist you, and of course the other service providers who can help you in this major purchase. So as we discussed some of the key steps of action for buying your first home, this slide details information which we have covered that will help you take action the right way. So you should begin by saving for a down payment early enough so you will reduce additional cutbacks. One way to save money is by starting a phantom mortgage. We mentioned earlier on the presentation that you can adjust your current budget to include an approximate mortgage payment. This can help you instill good habits for when you have a real mortgage and overall save for a real mortgage. This is called a phantom mortgage. Next, you should determine which type of home you can actually afford to eventually purchase. And remember that location is very important when you're considering this. After that, know about the government programs that can help you and understand which programs are actually going to fit for you. And lastly, you can always check out more program resources. Also, there are a ton of resources in the handout that you were being sent. So this brings our formal presentation to an end. Thank you all very much for listening patiently. We will now commence the question and answer portion of the presentation. Please complete the post-workshop survey. It is important that we ensure these workshops are providing you with the information you need. And if you completed both the pre-survey and now the post-survey, you will be entered into a draw for one of 4 $50 Tim Horton gift cards. Thank you. Okay, we have 2 questions here. Oh, perfect. Michelle's going to answer them. I was late. Am I still eligible for the $25 gift card draw? I believe that's the Lakehead one, so I'll let Michelle answer that one as well. Does anyone have any questions about buying your first home? All right, well, if no one has any questions, thank you all very much. And I hope you have a great evening. If you do have questions, feel free to stick around and we'll be happy to answer them. Thanks, everyone.
Awesome. Thanks, everybody. Yeah, I've put the post-survey link in the chat. Just put it there again. Yeah, and as Emily was saying, if you have any questions, we are happy to answer. What resources do you recommend for out-of-province housing? So are you wondering about living outside of Ontario and resources to find housing outside of Ontario, or for people? Yes. So that's really going to depend on the province that you're looking for. For purchasing a house, the like realtor.ca is a great resource, has a whole lot of information. And also look at contacting a real estate agent in the area where you are looking to move. So if you have an idea where you're wanting to move, don't contact a real estate agent where you currently live. Look where you're planning to go, because they'll be able to give you a really good breakdown of what that market looks like, right? You're bringing in an expert in that market as opposed to bringing someone with you who doesn't necessarily know that area well. I don't know if Emily, you have any other tips to throw out?
No, that sounds good to me. Like the presentation said, the realtors are the experts, so trust them.
We got another one here. What are the key economic indicators to consider when buying a house? So I would say for sure the biggest one to think about at the time is what's happening with inflation and interest rates. Because a change in interest rates, if you're looking to purchase a house and get a mortgage, right, we're not talking about even a car, we're talking about hundreds of thousands of dollars. So your interest rate that you have for your mortgage is going to make a very big difference in terms of how much money it costs you long term. Even a 1% in a change in an interest rate can be very significant. So you want to think about, what's happening with the market right now. If prices are going up, inflation is high, interest rates are high, maybe it's not the best time to be considering. And then especially things like, the housing market in general. The housing market doesn't always line up with the rest of the market. As we saw a few years ago, housing prices were really, really high, but general inflation was staying roughly the same. So there's really the 2 different markets you need to think about is the price of the house. Is the price of the house more than it should be worth right now? Is the price of the house inflated? And then the interest rates. Are the interest rates high at the moment? Are the interest rates going down? Hopefully that provides a bit of insight in that area. So to buy terrain instead of a house, is it the same process? Do you mean like to purchase a piece of land? If it's to purchase a piece of land, then yes, the process would be roughly the same. Doesn't always have to go through a real estate agent when you're just buying a plot of land. Sometimes you can make a direct deal with whoever owns the land. Um, if that's the case and you're purchasing directly from someone, you need to make sure you might have to get appraisals. You might have to have a survey done in order to separate the land into different plots. But if you're buying an already sectioned off and appraised plot of land, then yeah, the process is very similar. Just there may not be the same supports available unless you're purchasing it for the intent of building right away, and then you may be able to get some support for the actual building of the house. Like one of them, it was the major renovator new home purchase rebate, right? If you're building a new home, then that could qualify under that area potentially, depending on the size of the house, your income, things like that. But in general, the process is very similar. Are there any Ontario government assistance programs, particularly for two people who have never bought a home, buying a home together? Also, pros and cons of buying a house with another person for the first time. So all of the different federal programs we looked at would still be applicable for somebody buying a new home. You need one of you or your partner need to be the one, or if it's a friend or whatever the circumstance may be, need to qualify as a first-time buyer in order to be eligible for those supports. Pros and cons of buying a house with another person. The pro is you split the costs. That's going to be the major pro, right? It's the division of labor, the division of costs. It's not one person doing it. It's going to make it a little bit easier potentially if they have a strong income. The con is one, you have to deal with another person. So if you're not fully comfortable with that person, you're going to be relying on them for some of the costs. You're going to be relying on them for some of the work, things like that. And if that person has a poor credit score, they have a lot of debt, or they have a very weak income, then that could actually decrease your eligibility. Right? They could hinder your ability to get a mortgage if they're bringing kind of a negative balance with them. So it all comes down to what you're comfortable with. Yeah, the biggest pro is just that you are not responsible for everything yourself. The biggest con is that you don't have control over everything yourself. So kind of the same thing, but from opposite perspectives.
Thanks, Chad. That looks like all of the questions.
Awesome. Thank you very much, everybody. I hope you have a great rest of your day, a great rest of your semester. Thank you, everyone.